like we've made it through, and that's good news. Inflation, that is on a lot of people's minds, so that is one of the reasons why we wanted to have this. We have had 2 of these before. This will be our 3rd annual. I don't want to say annual, though, because of COVID last year. We obviously did not do this. The last one we did was 2020 in late January, right before everything in the entire world kind of hit the fan. So inflation is a concern. Obviously what's going on right now with Ukraine and Russia, the stock market volatility, as Chris said, kind of leading up to this before we went live on YouTube here. It is normal. It is part of a normal market cycle, but once you get into the volatility, it's much more difficult sometimes to live through it as opposed to just hear about it. So we're going to answer questions. We're going to have a panel discussion. Chris is going to go through the first half outlook, which he posted on the website in January, I believe, maybe early February. And from there, we're going to turn it over to you guys and also the audience in YouTube, and we're going to have a kind of on-the-spot Q&A, just because so many questions that were submitted prior to this, we had probably close to 100. We weren't able to obviously get them all into the questions that we've prepared for. So with that, Chris, I'm going to kind of turn it over to you to go through the first half outlook. And if you did attend the first, or the one we did a couple of years ago, it was very chart heavy and graph heavy. Today it's going to be much more conversational. We got a ton of positive feedback from that because it was so packed with good information. But today it's going to be more conversational. We do have on the side of the wall over here, it's a projector screen. Those on YouTube, you'll be able to see it. It'll pop up right on your computer screen. But if we do reference a chart or a graph, we're going to have it right up there on the wall, and everyone in the room will get a packet to go home as well. So, Chris, I'll turn it over to you.
Sure. Everyone, thanks for attending, and anyone who's viewing online, we appreciate the attendance there too. So, first is, just going backwards in time. We started doing some YouTube videos back in October of last year. Some of the first ones we laid out there were talking about, volatility, and in October, did one called Things That Lead, talking about just trying to be forward-looking, some of the indicators and data that we look at. In mid-October, we did another one talking, it was 4 signs of market tops, corrections, and crashes. That was another one, kind of get the tone. In late October, we did one on inflation, interest rates, and yield curves. A little technical for some people, I remember, but was thinking that those were going to be topics that people were going to be talking about in the first half of this year. Sure enough, they are. And then we did another one in early November called Warning Signs, Early Warning Signs to Volatility. It's called Getting Jiggy with It, after a song I really like. Yeah, Will Smith's song. So leading up to, we released the first half outlook in early December, and under the title, and you can find it out there on our website or on YouTube, under Curb Your Enthusiasm, Yields to a Bull Market Buy. And in it, we talked about, for the first time in essentially 2 years, we thought the first 10 to negative 12% correction was coming in the early first half of 2022, laid out some reasons why. There are generally more excuses. People kind of come up with stuff after the fact, announce Ukraine, a bunch of other stuff. But the main one being the Federal Reserve is going to be starting to tighten their monetary policy. Also talked about, we expected much higher sustained volatility with the volatility index that a lot of people talk about, the VIX index going to 28 or 30. Eureka, that's where we currently sit. Not a lot of fun for anyone. And then finally, we're talking about interest rates going on a 10-year Treasury to about 2.1 to 2.25% in the first half. We sit right about 2%. So all those things we discussed in December before this stuff happened, because history would suggest after 2 years of the Federal Reserve doing what they were doing, easing policy, that the time had come for the stock market to slow down, them to start raising rates, and volatility to return, and it's kind of normal fashion for a year. So, Eric, if I can get you to go to the slides here.
Number 1?
Yep. there's a little delay here.
Oh, it's a little delay on the...
Yep. I'm watching myself 15 seconds ago, so technical difficulties. Viewers, you're all guinea pigs, so.
So when I guess while we're waiting for this to kind of pull up, we'll have a little bit of a delay here, but we'll work through it. When you started to look at, Chris, some of the different components of volatility and what in the various markets that you pay attention to that kind of gives us a look into what possibly could be coming down the road. When we put these podcasts out, when we put these YouTube videos out to help convey to people what we saw as a possible volatile experience in the first quarter, you just talk a little bit about what some of those things are and why that portends to volatility in the future?
Sure. So as a lot of you here in the audience know, my background is very institutional in nature, so sometimes I talk about some pretty esoteric things that other people don't talk about. But simply stated, there's some things we look at in volatility markets that I'll tell people it's the cost of insurance. And there's some people who are much smarter than I am who price insurance to protect your portfolio. They price it daily, weekly, monthly. They price it out months into the future as if you were buying flood insurance or hurricane insurance. And these people, like I said, they're smarter than I am. They have more math degrees than I have, but they're really, really good at what they do. And over time, I've realized and looked at some stuff mathematically that you don't bet against these people. You don't bet against an insurance salesman. You also don't wait around like a lot of people have been doing the last 2 weeks and wait till the hurricane's already here and hitting you to go buy your insurance, right? That's when you're going to pay the most you're ever going to pay, and usually the storm is almost already over. So there's a lot of forward volatility markets that we look at in real time that you won't hear about on TV, but I watch constantly.
So Eric, on the YouTube channel, are the slides going to be real time?
No, there's a 15-20 second delay.
Okay. And then Megan, do you have the packets? Yes. Okay, could you go to hand those out so everyone in the room can follow along as we kind of go through some of these? So what we're going to show you now is, well, I'll let you kind of go through it because you can explain it.
Yeah, so the first slide that you'll have, and it should come up, is that 2022, people can do forecasts, and they do forecasts based on all this historic data. Presidential terms, they do it on Federal Reserve interest rate cycles, they do it on, some people do it on solar cycles. It's crazy the amount of data that goes into some of this stuff. But what happens is to come back and go, this is the way that the market is likely to look this year in a normal year. And the first slide that we have actually shows the normal path of the markets in the second year of a presidential cycle. Doesn't matter if it's Democrat, doesn't matter if it's Republican, this is kind of the average over time. And what you would see when the slide comes up is that the beginning of this year is almost exactly what the normal second year presidential cycle looks like, which is a very steep drop in January, maybe even a new low at the end of February, which we're almost there. And then the market starts to settle down, starts to regain its footing, and starts to look towards the middle of the year, the second half of the year, when it can see essentially a little more clarity. And it's got over the anxiety at the beginning of the year.
So a lot of what we're going through now is essentially uncertainty regarding how the Federal Reserve will raise interest rates, at what pace they will raise interest rates. And out in the distance, obviously, we have the midterm elections coming up here in November of 2022. So we have a little bit more uncertainty down the road there. But as the market started to pull back in December, which we'll get into in a little bit with some data as far as what happens prior to the Federal Reserve actually increasing interest rates, and then the market's reaction post an interest rate increase. What we've been seeing leading up to this point today over the past couple of months is some of that uncertainty, some of that fear and anxiety of people preparing for what is going to be an increasing interest rate environment. So not that, I guess, out of the ordinary. It's actually quite expected and really quite normal and healthy for the market after the type of run that we've had over the past 2 years.
Correct. It's it's literally the reason why back in early December we could write what we did about trying to forecast what the beginning of 2022 would look like. And no forecast is perfect. It's more a roadmap, and you're kind of playing the odds of the cycle. So the second slide that we have is actually a slide on volatility as measured by one of these measures, not the VIX that a lot of people talk about on TV, but some forward volatility. And when that slide comes up, what you'll see is that over the last 15 years, when volatility gets to this level, unless it's an event like the Great Financial Crisis, unless it's an event like COVID, this is about as bad as it gets. Now, volatility can get a little higher for a little longer, but usually that is kind of a climax. That's everyone just finally giving up. And once everyone gives up, the insurance salesmen are pretty much basically like, okay, I've sold you the highest priced insurance I'm going to sell you. The hurricane has passed, you panicked, I'm taking advantage of it, and people exhale, and volatility starts to come out. And what you're seeing right now in almost all asset classes is very high volatility. And it's manifested itself largely before Ukraine, in that the Federal Reserve has gone from this easy policy, we're going to print money, we're going to buy securities for a balance sheet, to, and we're going to raise rates maybe 1 or 2 times, to all of a sudden they started messaging, we're going to raise rates multiple times this year. Now, the estimates by some strategists on Wall Street are 7, 8 times this year, and my forecast is not anything close to that. I don't think Chairman Powell wants to put the economy in a recession or blow up the stock markets to start to calm down inflation, so I expect him to be more moderate, as he's been essentially outside of the COVID, when they started doing things with the balance sheet in an extreme way. So
it's kind of a segue into inflation. And Megan, do we have did we have those passed out yet? Yes. So
I think we're missing some up here.
Okay, so when we talk about inflation, so one thing I try to always tell people is almost every single headline in the news, almost every single headline that you'll click on in the internet, it's designed to get you to click. Because the more you click, the more money that they make. They sell ad revenue, and the behind-the-scene metrics, the advertisers can see how many people are clicking on headlines, how many people are going to websites, and they sell advertising essentially off those numbers. So everything is designed to invoke fear or some type of emotion. And inflation has been in the headlines for a very, very long time. But it's very important to understand that inflation is not a leading indicator. When we see the numbers, when we see everything in the headlines and the newsprint, while I do believe it is designed to get you to click and to invoke fear, it is also a lagging indicator. So Chris, talk a little bit about kind of some of the inflation data that we're seeing, where inflation is possible to go from here, and also how the difference between a lagging and a leading indicator.
Sure. So we were talking about this earlier today, actually yesterday. Troy and I were in preparation for this, and everyone wants to know about inflation. Now, the number out there on TV right now is 7.5% for PCE. We as an investment team, James, myself, the whole team, can't manage your investment accounts for 7.5% inflation. There's nothing we can do, really, to try to move everything over to combat 7.5% inflation. We can make adjustments, if we think inflation is going to be high and sustainable, but we don't think it's going to be high and sustainable at 7.5%. That 7.5% number, we have the data up here, over half of it is cars and used cars, largely because we have a lot of retirees in the audience, because your kids and my kids, who are millennials or Gen Z, who vowed they'd never own a car and were Ubering everywhere before COVID, decided, hey, maybe getting in an Uber or a Lyft with someone I don't know during COVID is not a very good idea. And I need a car, and I need a used car. And it's pyramided itself such that used car pricing is up 25, 30%. I'm getting people stopping me on the street to ask to buy my Land Cruiser. I'm not kidding, my 2007 Land Cruiser with 175,000 miles. They want to buy it, for over, this is insane. That part of inflation, which is goods inflation, is already starting to peaking. Is it peaked and going to just decline like a waterfall? No, because we have supply chain issues with semiconductors. Everyone reads about them on TV. Those are starting to actually loosen. They're starting to be able to get chips. And on the other side of this, car pricing is going to be declining back to a normal trend level. The goods inflation, we've got a chart here, literally went straight down during COVID. 2 years ago, Troy, myself, the team were getting calls on the guy on TV, the hedge fund manager, is calling for deflation in the Great Depression #2. Right?
Does anybody remember that a couple of years ago when deflation was the major headline?
Yeah. And it's literally 2 years later, and now everyone's screaming inflation or in the 70s. So the answer, I believe, is someplace in between. It's not going to be 2%, which is what the Federal Reserve was trying to get to for years. I think it's going to be 2.5% to 3.5% in the models. That's my belief. The advisors can model whatever they want. I think it'll be higher generally than it's been in the past, largely because baby boomers retiring, Gen X, which myself, a lot of people take an early retirement, labor force has shrunk. You got millennials and Gen Z reaching their peak purchase years, which the baby boom did in the 80s and 90s. They're buying houses, they're buying cars, they're having families. So they have demand for a lot of goods. And it's going to be higher than it's 1.5% to 2%. The Fed was like, we got to get this back above 2%. Well, it's 7.5%. I think it moderates down in the next 6 months to a year to 3%, something like that. And a lot of that is going to be what energy prices do over the next year.
And that is kind of the wild card right now with what's going on with Russia and Ukraine. I saw a Goldman Sachs report earlier estimating oil prices could spike around 13% with a full-blown invasion. Obviously, that's a forecast as well. But it's important to point out the difference between the inflation that we're seeing now and the inflation that you all lived through in the 70s when we had the sorry, the volume's on the TV down here. I thought someone was asking a question already. Obviously, we had the oil embargoes, and we really had, it was more of what we call a cost push inflation. Today, the inflation is driven by all of the money that the Federal Reserve has printed to put into the economy, which has stimulated demand for, as Chris said, for used cars, for new cars. Unemployment in the 70s was 6 to 8%. Oil went from $2 a barrel to around $30 a barrel. Just to kind of put that in perspective, that would put oil today that's around $90, $95 a barrel up to over about $1,000 a barrel. That would be the same type of increase, relatively speaking. Obviously, that creates hardship, that creates recession, that creates the possibility for a 5-10 year period where obviously the market could possibly be in trouble. I just want to point out the difference between what happened in the 70s and also with stagflation, which is high inflation and very low economic growth, and what's going on now. It's more of a demand issue, and then you combine that with what's happened with COVID as far as obviously it's the state, local, federal level. We're having shutdowns. We've had shutdowns, I should say, over the past couple of years. Various mandates and restrictions and things that disallow people that want to work from going to work. We're seeing it, on multiple fronts, but it's nothing like it was in the 70s, and that's why I think the fear of what happened in the 70s really isn't a valid concern at this point.
I agree. I don't think it's the 1970s. I remember my dad, complaining he couldn't get a 15% CD. We're not getting 15% CDs in the next couple of years, which begs the question. And there's a chart here about how high are interest rates going to go, and by interest rates I mean long-term interest rates, a 10-year Treasury, a 30-year Treasury. We have a chart. I'm not sure if we're going to be able to bring it up or not. That shows long-term interest rates have been in decline for 35 years, right? And it's been in a channel down for 35 years. I think the secular low in long-term interest rates was COVID, right? The 10-year Treasury got to 50 basis points. A lot of bonds in the world were trading at negative rates. Austria issued a 100-year bond that yielded like 1%. So yeah, just be glad none of these advisors bought you a 100-year Austrian Treasury bond, because it's already down something like 45%. You know, the people who buy those things are pension funds and endowments that.
It's for the long term.
Yeah, it's forever.
Do you have the pre-Fed hike, post-Fed hike market return data?
Yeah, can you guys pull that up? But we have this chart right here you're seeing is the 10-year Treasury. We've been in this downtrend for decades, right?
Hold on a second, Chris. So we can see it right here. Just so you guys can connect the dots on the wall. We do have the projector that's kind of showing what Chris is looking at down here. And that should kind of help you guys. I know it's a little dark in here, but.
Just went away. But so the 10-year Treasury has declined in essentially a channel for 35 years, reached a low of 50 basis points during COVID. It's risen back to about 2%. The average rate for the last 10 years, 15 years is about 2 to 2.5%. Didn't matter who's president, okay? Conservative, liberal, didn't matter. Didn't matter who was spending money, who was taxing. It's averaged about 2 to 2.5%, and we're just getting back up there. We'll probably go above there sometime later this year, but there's still a lot of demand for U.S. Treasuries, and with what's going on in the world, there's likely to remain a lot of demand for U.S. Treasuries.
So bring that back to what does that mean for people listening, people here in the room. The 10-year Treasury around 2%, might get to 2.25%, maybe up to 2.5%. Kind of where it's been at historically for a while. What does that mean for people in the market?
So people, if you have a long-term bond portfolio, bonds are stabilizers in your portfolio. Okay? They're meant to provide you income for a certain period of time. I think people are very lucky if they bought bonds 30 years ago because they had capital appreciation in addition to income. That is unlikely to sustain itself for the next years or decades. So when you buy a bond, if you buy a 2-year bond, you should be satisfied to own it for 2 years. The price will go up and down, and then get your money back. You know, if you bought a 2-year bond right now, you get 1.5%. And the price you see on your statement might go up and down the entire, 2 years. But at the end of the time period, you're going to get 100 cents on your dollars back if you buy a Treasury bond. We do not, in our portfolios, James, you can speak to this, what the duration of our bond portfolios are. You want to jump in?
So we cut out, I believe it was back in early 2021, I want to say. We've never really bought long-term bonds in any case. We removed most of our medium-term bond exposure back in early 2021. Been focusing primarily on short-term bonds, which is mostly a 2-year short-term Treasury and world government bonds. Currently, our net duration exposure is just about 2.5 years for our bond duration, which is very low. But that doesn't mean we sell every non-ultra short-term bond in the portfolio. We do maintain a slight allocation, it's very small, to investment-grade corporate bonds. But that's a part of diversification, where diversification doesn't just apply to a stock portfolio, it also applies on the fixed income side as well. But we do focus much more on the short term than the medium term or long term right now.
And bringing that back to what that means for everyone in the room and everyone watching here, for the past couple of years, we've been talking about what the Federal Reserve has been doing and why we should tilt a little bit more towards the stock market. But where we do have bond exposure, you hear a lot about when interest rates go up, bonds go down in value, and that's absolutely true. One of the ways to mitigate that and to protect against that is by having what James is talking about is what we call short duration bonds. So duration when it comes to bonds is how long it takes essentially for you to get your money back. When you take into account when the bond matures as well as the interest payments that it pays, if a bond portfolio has about a 2% or 2-year duration, that means no matter what the price volatility is in the short term, within 2 years, you're going to receive all of your money back. Assuming, of course, the United States government is operational and paying their bills, and of course we fully expect that. But that's how you mitigate.
Fingers crossed.
That's how you mitigate interest rate risk when it comes to bond portfolios. And it comes back to your financial plan. If you have bonds, a lot of times it's either because you want lower risk inside the portfolio or you need liquidity. Many people are either retiring in a year or two or have been retired for a year or two. And you're in that kind of red zone where we're worried about sequence of returns risk. So if we have a down year in the market, we need somewhere where we can go and we can pull money out, where we can withdraw income and not have to touch the stocks, which again, they are part of a longer-term investment strategy inside of a financial plan. So as we go through a lot of the questions that were pre-submitted and we take your questions, we're going to focus a lot on how everything that is happening in the markets, how that impacts your plan and how that impacts your retirement. Because the only purpose of money at this stage of life is to provide you security. I mean, that's the purpose. We want to make sure that we can put our head on the pillow at night and not worry about, are we going to have enough money? Are we going to run out? You know?
Yeah, and freedom to live your retirement. You worked 30, 40, 50 years sometimes for everything that you've worked for. And it's important that you're connected to your money and that you have that financial freedom. And fear is a big barrier to that. So peace of mind and freedom comes with a plan.
Megan, do we have the package yet? Could you bring me one, please?
So on the, great point made by Troy, on the interest rate side and the inflation side, there's a slide here in the packet that talks about, everyone's asking for what's an inflation hedge, right? And, you know, people on TV will tell you, gold's an inflation hedge or Bitcoin, and over long periods of time, we're not talking months and quarters, we're talking about years, 2, 3, 5, 10 years, stocks have been an inflation hedge because of the way that companies in America have been able to generate revenue, pass inflation-oriented costs onto consumers. We might not like that as a consumer, right? But as the shareholder, if you can pass on that cost through price increases or whatever, I love that as a shareholder. We've got a slide in here that, over long periods of time, inflation, has run 2.5% thereabouts. Stocks have returned between 7.5% and 8% higher than inflation. Not in a straight line. There's a lag, in the 80s. What were the best stocks in the 80s? Anyone remember the 80s? Even more broadly, consumer staple stocks, boring stocks, Procter & Gamble, Coke, Pepsi, boring, right? Not a lot of growth. What they were doing is they were raising pricing every year 3 or 4%, because what they were doing is they were looking back at the 70s when commodity price inflation was really high, and they're like, we're not going through that again. And consumers were like, okay, we're going to buy another Coke, we're going to buy another Pepsi. So, we might be seeing inflation now in the data. The question is what groups in the future are going to be benefited by, if we think inflation is going to be 2.5%, 3.5% over the next couple of years. Is it not residential real estate? Is it corporate real estate? Is it back to these industrial buildings? Because obviously offices are reopening. The mask mandates are coming down as we speak. I saw every day now it's a bigger company is saying, get back to work, come back to the office. Corporate real estate, even though I understand, telecommuting is the wave of the future, there'll still be price increases. Everyone was supposed to go buy a house. Apartment, price increasing and rents right now is going up equally as fast. So it's, you want to go, where is that inflation going to flow through? Maybe next year or the year after, because I want to be where the puck is going, not where it already was.
And that brings up a good point in regards to the types of companies and investments that we want to be in. Certain companies have margins that get compressed in high inflation periods. They can't pass those costs on to consumers. Other companies, they do have pricing power and can pass those costs on to consumers, and they can maintain their margins. But what the stock market is doing is it's always discounting the estimated future cash flows that a company is expected to generate to today's value. So they're looking at, okay, if in your example, Procter & Gamble and Coca-Cola, et cetera, if the stock market believes that these companies are going to generate growing cash flows in the future, that's going to be reflected in the price of the stock today, or at least moving forward into the future. So the stock market is never looking at what's going on right now necessarily as far as its long-term direction. Short term, of course, events can cause the market to have ups and downs, but one thing that really, to put some data to the numbers when we talk about the Federal Reserve, and I have it here. So this is page 8 inside the packets that you guys were given. It talks about the S&P 500's return 6 months before the Federal Reserve's first rate hike compared to the S&P's return 6 months after the first rate hike. So before the first rate hike, we have anxiety like we talked about, the market's preparing, we have uncertainty, we don't know how quickly or what pace they're going to increase short-term interest rates. So the market, that's when the market starts to retract typically, or at least starts to slow down. And that's because there's uncertainty. But once the Federal Reserve actually starts to raise rates, as you can see here, the data over the past, Chris, what is this, going back to 1983, almost 40 years. So the average return 6 months prior to the actual first rate hike, and keep in mind, that's the phase we're in right now. The Federal Reserve has not yet raised interest rates. They've only talked about doing it. They're preparing the market essentially for what's coming. The average since 1983 is about a negative 0.5% return, with the greatest drawdown of negative 19.6 in March of 1988. If you see that on page 8, I'm looking at the 1, 2, 3, 4th column. And then the next column, the 5th column, it's the S&P 500 return 6 months after the first rate hike. So a lot of people are saying there could be 6, 7, 8 rate hikes this year. We don't see that as likely, as Chris talked about earlier. But the 6 month return after the first rate hike has been an average of 8% since 1983. So Chris kind of coined a term the other day, we're in the storm before the calm. And that's really what's going on. There's some uncertainty with what the Federal Reserve is going to do. It's being exacerbated by the Ukraine-Russia deal right now. But once we kind of get through what's happening right now, we do feel pretty comfortable that we'll be out of the storm and more into the calm.
Yeah, I think I've said it on the YouTube videos. It's a sloppy, choppy mess, right? And it's not fun, but it's very normal. And it's just whoever was in the market in 2017 still has memories of there was no volatility and it went straight up all year. And that's not, 2017 is never likely going to happen again. Even the last 2 years with the very rapid but small decreases the market had, it was straight down for like 3 to 5 days, maybe 4 weeks, I think, in September, right up until the election, and then straight back up. And I kept telling people, this is noise, right? This is untradeable. We were able to see a lot of it and help our clients, and suggest Roth strategies during that time frame. This is a year, you've heard it probably your entire lives. Dollar cost averaging, 2022, dollar cost averaging year. No one is going to get you out of the top and get you in at the bottom. It's right now where volatility is, the average move intraday in the S&P 500 is 100 to 110 points in intraday, not over a week, every day. I'm not that good enough to trade it. I don't think anyone out there is. If you can find someone, I'll give them their money. I'll give you my money. If you can trade that consistently, we'll hire you. But some more data on where we are right now. I guess I was reading some data. In the last 70 years, there have been 33 declines of 10% or more. 10% to 20%. 10% as a correction, 20% as a bear market. I didn't make the definitions. In 90% of the time, within 12 months, the market was 25% higher. And within 24 months, I think the data is like 35% higher, something like that. So I know investor sentiment, here's another slide we have, I think, here in the charts, is very negative. Just in November, things were great. Everyone was happy, go lucky. That's when we started talking kind of negatively in our podcast, just concerned about volatility coming. Now, investor sentiment is as bad as it was during COVID. Think about that. Think about what was on TV during COVID. Think about what we were doing. We were doing nothing. we're stocking up on toilet paper, right? And investor sentiment is that bad. I'm not sure, who, this is the Association of Individual Investors that they poll, and it's very consistently good at being a contrary indicator. Will it find the lows in the market? No, but it's a great indicator about how people are feeling about the market. And generally, when you're feeling something, euphoria or despair, they're usually wrong.
In the financial world,
In the financial world,
It's-
right? Sorry. Oops.
at those points, that's typically when the market starts to go in the other direction. But I didn't realize that. I didn't see that the consumer sentiment was as negative now as it was during COVID. Yeah, that's interesting. Okay, so we are going to, and before Chris, I start to move into the questions that were pre-submitted and start to have a panel discussion. Anything else there you want to go through?
Yeah, the last slide. I think James is the one who gets to update this. We haven't updated for 2021. It's one of my favorite slides, and I think it puts things in perspective. And it's called I don't want to invest now because, right? And we hear this all the time, particularly when things are red. And go back and look at your life, right? Because your life is on this, right? I mean, we go all the way back to the 1930s, and we pick a couple of events happening essentially every year, and then you can see where the markets were that year and then down the road. And I know as retirees, we don't have that 50-year time horizon or 40-year time horizon, but it still puts things in perspective about how resilient our economy is and how resilient the stock market is over periods beyond months and quarters.
And everyone in this room has a financial plan. If you're a client, you have a plan. And where stocks and investments fit into that plan is in the long-term bucket. There shouldn't be one person in this room that is their lifestyle, their security, their security is jeopardized by a short-term 10%, 15, 20% correction in the market. My point in saying that is that stocks are nothing more than a tool. Bonds are a tool, real estate is a tool. What we fall back on in these times when things do get choppy, and this will not be the last time, is the financial plan and the role that these tools play in that financial plan. The market has never been down more than 3 consecutive years in the history of this country. It's happened 3 times, the Great Depression, World War II, and the dot-com bubble, 2001 and 02. Every single person in this room that has a financial plan, stocks and investments are a tool, but there's a plan of where we're going to get income. As we start to go through this presentation and we bring it back to the financial planning aspect, there is a reason why we have different monies in different places. There's an income plan, there's a tax strategy. All of these things are part of the Oak Harvest Retirement 360 process, and they're all working together. So for us, with the portfolio, we view that as a long-term mechanism to build wealth over time, and these short-term ups and downs, they don't impact the plan. They don't impact your security. They don't impact. They don't put you in a situation where you're at jeopardy of running out of income.
Yeah, I mean, I think I've said it on some of the podcasts, and a couple viewers said I'll buy a T-shirt that says that, and it's like, Oak Harvest, we're trying to meet your needs first and your greed second, right? Everyone wants more money, but do you actually have to have it in retirement? And we try to plan for the worst case scenario and what your needs will be, and then above that, we can address your greeds and the fun stuff.
Okay, so we're gonna segue here into the question and answer portion of the event tonight. We have questions that were submitted when people registered, so we've consolidated some of the themes of those questions into a few that we're going to go through now. I'm going to direct them to each of the panel members. Once we get through this part, we're going to take questions from everyone here in the audience and also those people on YouTube that may have submitted questions. So first one, we got a lot of this question, and it's, I'm going to retire in 1 to 2 years. How should I invest? What should I be doing at this time? And Jared, I'm going to direct this one over to you.
Yeah, I mean, it all comes back down to what we call the OCARVIS Retirement 360, right? All of you in this room have a financial plan in some capacity where we're able to help guide through time. And so it starts with building that plan, and it always comes down to a big thing when we talk about the investment side, which is risk capacity, right? Your capacity to take on risk. This is where everybody will be a little bit unique in how much of the long-term versus the short-term buckets. A lot of people probably heard the bucket strategy out there. And so it's really important to understand that there's a process as you grow. Grow your money, and then as you move into those retirement years, there's a different process that has to happen, from a tax strategy, from an income strategy, how we shift money around to take that out during different times in the market. So that's a big part of the overall, is finding out with each particular person, couple, what their capacity for risk is, what their need for income, how we're going to define the taxes over time. And that's where it comes down to each advisor and how we're going to help you guys do that. So.
In the capacity, just to define that, if someone needs to pull 4, 5, 6% per year out of their portfolio immediately, well, they have a low capacity for risk. Because if you need to pull 6% out and the market goes down 20, okay, you've taken 26%, and that's your first, second, third year of retirement. Your portfolio, therefore, has a lower capacity for risk than someone who maybe doesn't need to touch the portfolio or only needs 1 or 2%. So when we look at building investment strategies as part of an overall financial plan, one of the big components, the very first appointment I had with you, Jared had with you, Jess, any of the advisors at our firm, we really talked about maybe not directly what's your risk capacity, but that's what we're trying to identify on a first visit when we meet with clients. And that is the building block from which everything else from that point forward happens. So once we finally have that plan in place, it's all based on the fundamental truth that the most important thing that we do for clients is make sure that they're protected, that they're secure, and they have a plan that allows them to feel comfortable with where the money is, how it's invested, and where they're getting their income from. Without income, there is no retirement. So that is our number one most important responsibility. So.
Yeah, and I'd like to add to that really understanding a client's vision for what retirement is supposed to look like. That's gonna, the numbers and the analysis, we get that comes with the discovery appointment, but really reading between the lines and understanding who is that person as an individual or as a couple, and what are their goals, what are their objectives, what does their lifestyle need to look like. That factors into the questions and the conversations around risk capacity and the investment planning and how we would achieve those. I like to ask a question at some of my live workshops, and it's, if you were going to go to a cabin with your family members and you're about to put together a puzzle, where would you begin with that? And consistently I get the answer, well, you start with the edges, Jessica, or you organize the puzzle pieces, you put them all out so that you can know which direction you're going to go. And I oftentimes have to back them up, not only in this analogy, but also in meetings, and say, what is it supposed to look like? The very first thing that you do when you go to put a puzzle together is you check out what that baby looks like on the box, and that gives you your vision. And so I know with the clients that I work directly with, vision is a huge topic that we have in our appointments and our visits, and it's a large part of the discovery process, which feeds nicely into the risk capacity conversation and helps us to put the numbers to work for our clients.
Okay, so James, I'm gonna go to you. James is our senior portfolio manager. So James you do have the podcast that you started, but James is a very, very critical person behind the scenes at OCARVIS Financial Group and has been for several years. We got this question a lot, and it's should I go to cash to protect my retirement?
Yeah, it's a question that comes up all the time, and it's something that every investor is going to have to face at some point. Even if you're not necessarily facing retirement, if you're in the capital markets, there's going to be a time where your account declines by a lot, and it declines very fast. And that's going to be a gut check moment. Like, what do I do now? Should I just sell my stocks and go to cash and just get out? And the first thing to recognize when that comes up is that primarily that's an emotional response. That's your emotions talking to you at that moment in time. And that's real. Those emotions are real. It feels terrible to see your investment account go down. And the longer it continues going down, the worse and worse it tends to feel. But making the decision to go to cash has consequences, serious consequences. It's a big decision. And unfortunately, more often than not, going to cash tends to result in wealth destruction rather than wealth preservation, which is what you're trying to do with that decision. We have a chart somewhere in there talking about what happened over, say, a period from January 1st, 1980 to March 31st, 2020. If you invested $10,000 and just held it over that period, you'd make about $700,000 or so at the end of that period. But if you missed just the 5 best days over that period, you would lose somewhere around 33% of the lifetime return in that investment. If you missed only 10 days, so closer to 50%, I want to say, of your return would be disappeared. And if you happen to miss the best 30 days over that whole period, think of how many days that is, close to 60 or 70% or more of that lifetime return is gone. So when you decide to go to cash, there's quite a bit of gambling involved in that. You're taking on a lot of risk by thinking that you're removing risk. So it's a big consideration, and for most people, most of the time, the choice to go to cash is not going to be the right one.
And the right one, and what we preach and how we build financial plans, is to build the plan around when you need income, how much income do you need, and how much do we need in a place that's protected from if the market goes down and we hit a 1-year, 2-year, 3-year pullback in the financial markets. Will your retirement be impacted? Will you have to work longer? Will you have to go back to work? We're building the plans around those considerations. Is it Jared's microphone that's not working? Is Jared just the black swan or black sheep today?
What I'm understanding is we're going to pass my mic. Okay. So when someone speaks, give them the mic. Yes.
I'm good? Okay. They know who to make sure is taken care of.
Yeah, we'll give you the mic, we might not get it back.
So they turned it on.
Okay, so coming down this list here, so one of the questions that we got, and for those of you who have not followed the YouTube channel, it started out where I was doing financial planning videos, and then I'd say about 6 months, a year ago, Chris started putting his podcast, which he's been doing for, I believe, 4 years now, every single Friday, sending it out to all clients. He started putting that on YouTube. So we've been talking about, through Chris's podcast, the volatility we were anticipating in the first quarter of 2022. And a couple of the questions that we received said, it was directed actually to you, Chris. We've been saying since November, this is the question, that the market was likely to be choppy in the first half of 2022, kind of parlaying on that last question. Why didn't you go to cash, or I'll adjust it, why didn't you make significant adjustments to the portfolio if we saw this volatility coming as early as November of 2022 and had it on the podcast communicating to clients?
It's a great question, and it tag teams with what James was talking about, because we can predict, forecast, hope, guess, whatever, with our tools that we're going to have a market pullback of 10 to 12%. Okay? We're in a financial planning firm first. Right? You sit down with an advisor, you figure out a financial plan. What James and I do on the public side is a tool for that financial plan. But theoretically, you're 70 years old and you're 100% stocks, which most people probably won't be at 70 years old, but you're 100% stocks. And you're 100% the S&P 500. And I am that good of a manager that I can sell the exact top on January 3rd, all of it. Well, I'm going to sell half your portfolio because, I'm not going to sell 100% to cash. I'm going to sell 50%. I'm that good. I'm going to sell half of it, and I'm going to wait and wait and wait and hope I find the exact bottom and put that 50% cash back. And it's down 10%. And you can work the math, and you would save 2.5% versus the down 10% on the overall. And if you're wrong by minutes, hours, days, your return totally dissipates. So, we fall back on what is the retirement plan. We were messaging back in November, October to the advisors. When your client calls up and you do a review, talk to them about volatility coming up. They were messaging volatility. Very few people were like, oh yeah, I can't handle 10, minus 12%.
So a lot of why we have the podcast, why we have the YouTube channel when it comes to the investment discussions, is to help clients feel comfortable with what we see coming in the markets. It's not to tell you, we're not a hedge fund that's charging 2% annual fees and 20% of profits. That's what hedge funds do. As Chris said, we're a financial planning firm first and foremost, and investments are a tool that helps to accomplish the financial plan. But when we start to look at that getting in and out of the market, which I know some firms do, no one in the history of the world has ever been able to do that consistently and make money. But when we start to talk about the emotional side of that decision, think about COVID. Think back to March, April, May of 2020. Okay, we were sending videos out. We were communicating with every single client. We were on the phone. If you think back to the emotions of how you felt and where we were in the middle of all the government lockdowns, everything unknown, everything uncertain, if you had gotten out, there's almost no way you're actually going to put your money back into the market if you put yourself in those emotional shoes in March, April, May of 2020, because if you were so concerned and got out of the market either halfway down or all the way down or whenever that was, just think about the emotional side of things. So that's all I'm saying here is we are human beings too, and if we start to try to play that game, we're almost outsmarting ourselves or putting ourselves in a position to where we have to make decisions now. When do we get back in? Do we get back in? And that's not a realistic way to manage money, especially when you're doing it for other people that haven't trusted so much to us. So again, I fall back to the financial plan. Those of you that have money in stocks, and we have some of you are 100% stock or 90 or 75% stock. Others are 25, 40, maybe 50% stock. Everyone has a different allocation for the most part. Whatever allocation you have to the stock market right now, it's designed for your retirement. It's designed for all the goals, everything that you've told us that you need, your income. It's part of your tax plan. It's all working together in concert with one another. So trying to time the market, getting in and out, ultimately creates room for human error. Whereas we know over time, the only thing we ask clients to believe as far as the stock market is that capital markets appreciate in value over time.
And can you all hear me? Yeah. Okay. As we tie it back to the financial plan, a really, really important part about what we talk with our clients is the income side, right? No such thing as retirement without income. We have to have an income source in here. So it's designing the plan with the investment team's job as the capital market, always lapel here. With their job in the capital markets, the bond market, is to control what we dictate from the financial plan to them, so that they know each individual client is going to be invested in a certain allocation. The advisor's job is to decipher where this income is going to be coming from, in both markets going up and markets going down, and sideways and everywhere else. So it's just having these things put into place over time so that when these happen, weathering the storm, as Chris talks about, when these things happen, because they will, we need these places to go get this income without having to worry about, do we time this market? Do we go to cash? Do we do these things? Because at the end of the day, those are emotional decisions that typically don't end up being the best decisions for us long-term financially.
Okay, so Jess, I'm going to come to you with this one, and this one kind of really touched me. Many of you know my story with my grandfather and my grandparents, and why we started Oak Harvest Financial Group. But a question came in, Jess, and it said, my husband recently passed away, and all of this is so new to me. What should I be doing? The stock market has me scared to death about running out of money.
Well, first of all, I'm sorry for your loss. Losing a spouse is one of the most stressful experiences that a human can go through in their lifetime. And it's emotional. And I'd like to caution you first and foremost that you don't make a knee-jerk decision while you're in an emotional state of vulnerability. Whether you feel good one day and bad the next, give it a couple of months, 6 months, a year. Take the time that you need. And during that time, a great starting point to have a financial conversation is to begin interviewing advisors. Ask questions. Go through the discovery session. During a discovery session with an advisor, you're going to get so much perspective on where your portfolio, especially if you were not the one tasked with overseeing that. Generally, in generations much older than myself and beyond, it is the man that was the plan, that was taking care of the finances. That's very common. Ask questions, go through the discovery period. It's going to give you some awareness of your unique situation and where to begin. And I'll say it one more time. Ask questions to your heart's content. The person that you're interviewing in front of you should have the patience, and it should be their mission that you have understanding around your financial plan. While you're having that conversation, I'm not finished yet. While you're having that conversation, I was letting it land because it's very important. While you're having that conversation, it's also important to have thoughts about that person. Is it somebody that money's personal. Is it someone that you feel comfortable that you would call them when life changes again, when something good, a blessing, or something devastating like losing your spouse happens? Are you going to be able to come to them with your fears, with your uncertainty about the market? Running out of money happens to be the #1 concern amongst women. They don't want to be the bag lady under the bridge. That's very concerning, and it's a viable fear. And feeling connected to your money, having that understanding around where you are is going to be the pathway to having freedom, which is on the other side of that fear. The market will do what the market's going to do. It's going to go up, it's going to go down. To tie a bow on it, a financial plan is what you should be seeking understanding around. A plan that's going to address where's your income coming from. How does being in the single tax bracket affect your tax planning? And who's going to take care of you in your later years of life? What is the plan for long-term care or in-home health? I like to think of our team and our softwares as bumpers at a bowling alley, simply put. We are the bumpers. We're keeping your retirement out of the gutter, and also we are making sure that you, the bowling ball, are continually hitting strikes in retirement. So please, I caution you, start the conversation. Kudos to you for being proactive, even asking that question during a time of duress. And don't act emotionally. Get the information that you need, and that's the mission right now, your information gathering.
And I should have prefaced the question. We had a couple hundred people, I think 300 or 400 maybe, register that are not clients. So that came from a client or someone who registered for the event today that's not a client. If you are a client, you have a plan for that.
And we're the first people that you call if you were to lose your spouse. We are not an afterthought. That is what we are here for.
It's our most important responsibility, actually. And it does happen about 10 to 15 times a year where a client passes away, and we handle everything for the spouse, at least everything that we can, from the paperwork to the transfer of assets, to setting it up, to getting the appointment with the attorney as far as new documents, new everything structured.
We really try to get ahead of it. I mean, that's the best time to prepare is, one of our CFPs, Nicole Riney, she put together a survivor's checklist, and that's the best time. So if you are a client and you haven't seen the survivor's checklist, please make sure that you request that, because getting ahead of it is the best way to be proactive.
Okay, so James, I'm going to come back to you real quick. I know we're a little bit over time here, but I want to make sure we get some of these questions answered here before we turn it over to the audience. A few questions again along this line, and Chris, feel free to kind of chime in here too. What adjustments have we been making since the fourth quarter of 2021? And moving forward, what adjustments are we planning on making to the portfolio and the investment strategy?
Well, in the fourth quarter of last year, probably the biggest change that we made was we actually took profits on quite a large number of positions. So we didn't go to cash or close these positions, but a fairly large number of our more growth-oriented positions had grown to be very overweight in the portfolio. If, say, a target weight was 3%, it might have grown to be 5 or 6%. So November, December was a period where we were trimming those positions down quite a lot to bring them back into weight, and then rebalancing those funds either into other equity positions or into non-equity positions. And that whole process is called rebalancing. It's a form of risk management, essentially, where you take some risk off the table, your portfolio's gone out of whack to your target model, we bring it back into alignment with the target model by doing that exercise. And with an eye towards things like rising interest rates and inflation, before I get into that, one thing I'll mention about the way we generally manage stocks is the changes we make are not as dramatic as some people might expect. Our basic view is that we need to hold a broadly diversified portfolio of good companies, dividend payers, dividend growers, growth stocks, across most industries and sectors all the time. And that's how we view it. So when we make changes, it's more along the lines of adjusting the weights of positions, or in this case, leaning slightly more into things like energy and real estate, things that can do well in an inflationary environment, financials, things that can benefit when interest rates rise. But we're never really just chopping names left and right out of the portfolio, buying new stuff, trading in and out, trading around Fed announcement, things of that nature. And Chris can speak to that as well.
Yeah, I was just going to say, as you guys are aware, you don't see a ton of trading inside your portfolios. We do see some repositioning and some adjustments, of course, being made. But we believe in capital markets long term. We believe in capitalism. We believe in the United States. We believe that companies here are going to continue to grow and make money. There will be challenges. There will be bumps in the road, of course. But again, that's where the plan comes in. We have a certain amount allocated to stocks, and that's what they're designed to do, is for the long-term growth. But keeping a diversified portfolio as opposed to chasing the next trend over the subsequent 3 months, or what we anticipate happening over the next 3, 4, 5 months. You start to get into that chasing your tail, so to speak, where the truth of the matter is, one of the most sound investing principles, proven decade over decade, is to simply own good companies that are growing their profits, are growing their margins, and not being wishy-washy and moving to every single, trend that's out there.
With volatility as high as it is, we're going slow. I mean, there are times for 2 years that when we were going to make changes, when we were going to get new clients invested, we were telling them, instead of 6, 8 weeks or months, it might be, a couple weeks, because we could see opportunities all building around one point in time. That's not this kind of year. So new clients were going relatively slowly in buying new positions. And you guys can, if you open, if you watch TV or whatever, you see really good companies. They report a quarter, they beat their numbers, the stock's up 10 in the morning, and by that afternoon it's down 10, and then it's down 6% the next day. The moves are very fast, it's computer driven, and we're just in one of those times. And so we're going slow on changes. I'm going to ask everyone out there in the audience, what's the one industry that's positive year to date? There's only one, energy. The number one group 2 years ago when everyone was talking about depression that everyone in Houston wanted out of their portfolio? Energy, right? 2 years ago was exactly the height of ESG, clean energy, oil traded at -30 or -40 a barrel. I was thinking of trying to order some and put it in my pool. And now it's the only sector up year to date. So we have broadly diversified portfolios. We own some energy companies. We still own some technology companies, and they've gotten bludgeoned, right? Not necessarily because of the earnings they're reporting, but because of multiple compression that's happened in 2 months, because people decided, the Fed's going to raise rates 7, 8 times, whatever the number people are pontificating. I don't think that number is as high as other people think. And most of those technology companies still have high and sustainable revenue growth. And the thing that I look for is better or improving return on invested capital. So what you've seen the last month, and we own a couple of these stocks in the portfolio, I'm not going to name the names, companies have reported good numbers, and then they said, we're going to go spend $1 billion on a new plant. And you'll hear on TV, it's like, wow, that's great. And you'll see the stock open up, and it'll go down for 2 weeks straight. And it's because portfolio managers bigger than ourselves will say, I don't want to wait around 6 months to a year for that company to spend $1 billion to find out what revenue a year from now or 2 years from now they're going to derive from that. So I'm selling it. We are more longer term focused. There are times we're going to sell stocks. We're wrong on what that marginal return is going to be in the future. But it's a sloppy, choppy mess right now, and things are moving very fast, so we are going slow.
Okay, I'm going to go kind of rapid fire here because we have questions from YouTube coming in, and I also want to get your questions. We had a couple more, so just kind of rapid fire, 30 seconds a minute. Jared, should I increase or decrease my spending because of inflation or market volatility?
Probably not time for slides then, right?
No.
This is a big question we've been getting a lot over the last 6 months is, what do we do if taxes rise? What happens if inflation is, higher than what we ever expect? And it always just comes back to the financial plan. We go back in, we look at it, we play with it. We can call them what if scenarios. We can go in and say, okay, what if I spend more? What if I spend less? What does that look like over the long term? Some of you guys have always heard us say, there's different periods of retirement. You got your go-go years, your slow-go years, and your no-go years, right? Your mobility, your health typically tends to decrease as you get older. And so we can put those into the planning that can help combat these things of rising taxes. But the other part of it is getting in and looking at taxes. How is that going to affect us both now and in the future in an unknown environment? And we have to make assumptions. It's financial planning, but we can go and do that and plan accordingly and then take action based on those. So.
Yeah, one of the cool things is being able to actually sit there and go through, and you guys that are clients understand this, if you have a question, can I spend more, can I spend less, what if I do this conversion, what if I do that conversion, modeling these different scenarios and seeing the potential outcomes that they have on our security short-term and long-term, that's why we say financial planning is most important. It's not going to be 30 years from now, I wish I would have owned that stock, I wish I would have owned that bond. It's going to be, did I spend my money and enjoy my retirement, enjoy my family, enjoy my kids, enjoy my grandkids? And that's what matters when it comes to retirement. It's, do we have enough? Are we not going to run out? How do we pay less tax? How do we keep more in the family? And if something happens to me, will my spouse be okay? And those are the big questions that everything that we do is centered around. That's why we exist, is to help you answer those questions and to put things into context. So you don't have to worry about what's going on with Ukraine or Russia, or you don't have to worry about what's going on with the latest COVID variant. So with that, we do have a couple of questions from YouTube coming in. Russia and Ukraine. Effects on the market, impact short-term, long-term. Obviously, oil prices could go up. Anything significant? James, Chris, you guys want to throw in about this topic?
We can only tell you the data that we have on prior conflicts. James actually, I think, shared it with me yesterday. There were like 5 prior conflicts. If you look, Afghan War, Iraq, you have to list them.
Crimea.
We can send them out to clients. The market has historically bottomed within essentially the week of the first firing and gone up after that. The worst case scenario is usually priced in immediately once the munitions start firing or the bombs start dropping. So obviously this is affecting oil prices. It could affect grain prices because Ukraine, is a large wheat producer. So bread prices might go up. But at the same time, that would benefit our agriculture sector here in the United States. So, do you buy agriculture or machine equipment companies because they'll have more money down the line because their pricing are higher. So these are the things we think about. We're not acting on them, on any given day or any given week. We're trying to think, okay, is this going to be a trend that we should pay attention to for the next 6 months to 2 years?
And it goes back to what we were talking a lot about during the COVID times, in the beginning especially. COVID was what we call an event-driven recession, where it's an event that happened. Those typically last 4 to 8 months. Of course, this is very unlikely to cause a recession of what's going on out right now with Russia and Ukraine, but it's not a structural event to where we're worried about a 25, 30, 40% collapse in the market because of what's going on. It's mostly noise at this point, and
yeah, it should be noise to America currently. It's not like COVID. COVID, it is a little bit more like COVID in that it looks like it's a one-time event. It's going to drag on because it seems like Putin is a very smart man, and no one can get into his brain except for him. So, is he going to move? Is he going to sit there? We don't know. I'm not a political scientist. I don't invest the portfolios based on my political view or yours, right? The portfolios are designed based on, return on invested capital, regardless of who is elected. Later this year, I know there's a big election coming up. There was a lot of our clients wanted to talk about the election in 2020. I'm already talking about this election. I've been talking about it already because I listen to, what our clients are watching on TV. I watch Fox News. I watch CNBC. Everyone at the office is probably like, why do you have those headphones on? I'm like, I want to know what our clients are watching and reading, and I try to react and put out information in advance. So we'll be putting out stuff about the upcoming elections and what the market generally does.
As far as the podcasts, a lot of the information. And as far as me saying that what's going on with Ukraine and Russia is noise, I'm speaking directly and only about within the context of how it impacts your retirement. Obviously, it is a very serious situation, and a lot of people could die. It is nothing to be taken lightly. But as far as your portfolio, your retirement, noise in the sense that we don't expect the market to go down 30% because of what's happening over there. Not going to talk. We got some questions coming in about the U.S. debt.
I did a podcast.
Did a podcast. So whoever asked on YouTube about the U.S. debt, is that upcoming or is that?
It's out there.
Do you know the title of it?
It's under News or Noise.
Okay, so
we for YouTube viewers who are not familiar, we release a News or Noise segment on Wednesday, and it is entirely news or noise to your investments, right? This isn't to your emotions or to anything else lifestyle. We're trying to dissect what you're watching on TV, what you're reading in newsletters. Will it affect your investment portfolio here and now?
Okay, so a couple questions on here about Social Security, but before I go through the rest of the YouTube questions, I want to turn it over to everyone here in the room. Any questions that you all have for the panel? That means we're doing a really good job, eh?
Yeah, we answer them all.
Did we put you to sleep with the barbecue beforehand? Okay, so coming here to Social Security, a couple questions here. How does Social Security, with what's going on in the market, and Jared, I'm going to throw this one back to you because Jared's vice president of our firm, also head of the advisors. Jared, Social Security, the impact of electing Social Security in regards to an overall retirement income plan, or I should say the impact of income and portfolio, someone's portfolio, relative to when they take Social Security. Does what's going on now, should that impact their decision?
The biggest thing we see with Social Security across the board, we've got a number of advisors here that are all Social Security advisors, National Social Security advisors, and so when we look at this, it is so, I hate to use the saying it depends, but it is so dependent on each unique situation, on when to take it, when the spouse should take it, and all the different varying factors in there. It's based on longevity, it's based on your financial plan, but most importantly, it is not based on boilerplate information. It's not based on what your neighbor does, right? It is not at all what it is. So it's sitting down to figure out, we don't just look at Social Security in a bubble. We want to look at it in context with everything else that you guys have inside your portfolios, from a tax plan to everything else. So the impact of tax planning, if we take Social Security earlier, means maybe we're going to have more income, less impact on tax planning. So it's going to play with each other across the board inside of that financial plan. It's just real important to understand the impacts of those and what that looks like.
And also how the portfolio is invested as well. So Social Security, it's an integrated financial planning decision. So someone who is more comfortable with the markets long term, for example, I could definitely make a case that it makes sense to take Social Security earlier, depending on your income situation, and leave the money invested, because I would expect money in the market long term to return better than what you're going to receive from Social Security. Not to mention, only God knows how long we have, left to live. But if you're very conservative, for example, I may have a concern that if you have a higher spending need, you won't invest the money aggressively enough to grow and to keep up with your life expectancy. It may make sense to defer Social Security and live off a little bit of the savings so you have higher guaranteed income later in life. There's nothing more secure in retirement than having a guaranteed income paycheck. whether it's from a pension, whether it's from Social Security, whether it's from an annuity. Real estate obviously isn't guaranteed income, but if you have someone paying you very long time and you feel confident in it, no one's ever came to us and said, Troy, I'm really tired of this check being deposited on the first of every month in my bank account. It's never happened. So different cases can be made for when to elect Social Security, not just based on your income situation, and especially not what your neighbor has done, because we've heard that so many times. Troy, I'm thinking about taking Social Security because my buddy at work did. It's how is the money invested, what are your income needs, your health, life expectancy, and tax plan. Tax plan's a big one, because if we start taking Social Security, that's going to fill up the income tax bracket a little bit more quickly. We're going to have less room for Roth conversions. If you guys have $1 million, $2 million, $3 million inside these retirement accounts, you have a massive tax problem that, if not addressed, it's going to be big down the road, and everyone sitting in this room understands that. Okay, has anyone here came up with any more questions? Since I put you on the spot last time, giving you a couple more minutes to think about it at this point.
I got you.
Hello. Excuse me. Hello. My question is for folks like myself who are recently retired and may be in a situation where they are looking at Roth conversions. The market is clearly in a down situation right now. Is this a time to focus on converting funds from traditional IRA to a Roth IRA, or does it matter? And also, just another comment, do you see the government fiddling with the Roth or the IRA accounts in the future?
Yeah, so I mean, we've been big proponents of doing Roth conversions when securities are on sale. Essentially, if you have $1 million in the retirement account, it drops to $800,000 in value. We believe in the markets. We believe long term they're going to be much higher. So the temporarily, in our opinion, reduced value of those securities, we can move them over to that tax-free Roth environment, and our belief is they're going to grow back tax-free. So essentially, we're getting a discount on the taxes that we're paying by executing at that time. I don't know the exact number, but we probably did somewhere between $10 to $20 million of Roth conversions for clients in March, April, and May of 2020, so near the bottom of COVID and moving up. We were telling people January, February, March, April last year, 2021, that's when we want to do them, because we expected it to be a really, really good year in the market. We have had clients do Roth conversions this year. We've not sent out the mass email because, again, we're taking things a bit slow right now. We're taking a patient approach. We don't expect the market to rebound 10% over the next week or month or even 2 months. It's going to be a little bit bumpy over the next few months, and in our opinion. So the time to do Roth conversions, you're never going to get it exactly right. We do think it's probable doing it in the first half of this year will be more beneficial than doing it in November or December. So we haven't pulled the trigger and told everyone we think now's a good time to do it yet, but almost certainly, I should say, our intention is to get that email out over the next month or two. Phone calls, we have a list of everyone who has a tax plan doing Roth conversions. We're going to be reaching out to you. If you want to do it now, now is a great time. But there could be a little bit more choppiness, especially with what's going on with Russia and Ukraine right now.
Yeah, I'd like to add there, a real important thing with this is just like with the markets, right? We don't want to try to time it perfectly every time. It's about the overall, over the course of a 30-year retirement, it's about the impact of doing it year in and year out. And if you hit it at 10% down or 10% up over the course of 30 years, it's not going to make a drastic difference. But if we can find it in those times and we, quote unquote, maybe get lucky or just happen to be sitting down to talk about the tax plan and the market's down 2 or 3% from its recent highs, great time to do it, right? Even if the market's up 2 or 3% from its recent highs and creating new highs, that's still a great time to do it because we're impacting the overall plan positively moving forward, at least if we feel taxes are going up in the future, or tax rates specifically in the future. So,
and for many of you, even if tax rates don't go up, the forced distributions from the accounts will force you into, in many situations, much higher tax brackets in the future because of your Social Security, any other income sources that you have in those required minimum distributions, which get to be 4, 5, 6, 7, 8, 9%. They are large.
Yeah, and to answer the other question on changing of Roth, we don't know, right? There's no way we could potentially know, but the best thing or the easiest way to look at it is typically anytime they make big changes, everything's usually grandfathered in on things like this. So we just kind of have to go forward historically speaking and looking out into the future that is probably going to be what happens. There's been talk about income limitations on the amount of Roth conversions and things like that, but at this point there's been real no traction with it. So until we hear anything else, probably not this year, being an election year, I wouldn't assume that we're going to see anything soon on that there.
And thank you, Jared, because I forgot to answer that part of your question. The second part of his question was, do we see the government making any legal changes to Roth conversions? So I guess kind of a two-thing there really is, like Jared said, if you've done Roth conversions and that account is tax-free, we fully expect that there is significant precedent in place that tells us that all of that money will be tax-free forever. But what was pending and got squashed at the last minute by Senator Manchin was the Build Back Better Act, where they were going to eliminate the ability to do Roth conversions if, I believe, you were a single individual making more than $400,000 a year and a married couple more than $500,000 per year. That was taxable income, not adjusted gross income. So it's on their radar, that's for sure. And again, Jared, very, very valid point and crucial point in the planning side of things. The most important thing is that we're getting this done year in and year out. We're doing these conversions. Maybe it's not conversions for you. Maybe your plan is we live off that income. We're pulling income out of the IRA. It all depends on what those calculations are when we extrapolate the value out into the future. If you're looking at $150,000, $200,000, $250,000 of a required distribution, and you have Social Security, 2 spouses, you have some dividends and interest and other income, and all of a sudden you're at $450,000 of income, which if you don't do anything about the problem, many of you will be in that situation, then and not know it. Today, especially many people watching, it's you're going to pay a lot of taxes. And as we say, it's not if you're going to pay taxes, it's how much and when. But we're all going to pay.
Troy, I'd like to add to that. If there is somebody out there in the audience, YouTube, or even in here that has recently lost a spouse this year, there is tremendous opportunity to talk to your advisor about a Roth conversion, because you have a calendar year at whichever point your spouse passed away within that calendar year. So if it was January or February of this year, you have until the end of December to go ahead and file. You can do a Roth conversion under the joint amount, which is about double the threshold than it is for a single filer. And so there is tremendous value in having that conversation sooner than later to see if that's applicable. After this December 31st, or if, heaven forbid your spouse passes on December 30th of this year, you have 1 day to file jointly again. And so it is beneficial that when you lose a spouse that you do seek guidance, especially around tax planning.
It's one of the most punitive aspects of the tax code is when one spouse passes away, the surviving spouse, unless they have dependent children, goes into the single tax bracket. Even if you have dependent children, you only stay in the married filing jointly bracket for 2 years. It's a huge oversight. Maybe not an oversight, it's probably intentional, but it is one of the most punitive aspects of the tax code. Thank you very much for that question. Any other questions from this audience here? Okay, I think that's going to go ahead and wrap us up for tonight. Guys, do you have anything you want to add?
One final thing, I'd like to ask if Chris could just reiterate our 2022 outlook for the remainder of the year. Like, what do we see happening as we get towards the end of the year?
So, thanks, James. It's a mess right now, right? And everyone asks, well, do you have a crystal ball? And, I say, we have a crystal ball, but it's murky. And it's never precise, right? There's a difference between accuracy and precision, and people mix them up a lot. what we see going on is a lot of volatility now. If you go back and you can look at the first chart that we passed out in the packets, that is essentially what the year should look like. A lot of noise. I mean, if it's a perfectly normal year, a lot of the noise that we've seen the first 2 months is about to go away for a while. We'll get a rally, a relief rally in March into tax day, something like that, and then we're going to get a lot more noise during the summer. And as you progress throughout the year, largely because I think people will become more comfortable that the Fed doesn't want to blow up the economy and the markets, that as we get closer towards the middle part of the year, volatility will come down. As we get closer and closer, believe it or not, to the midterm elections, historically the market has started to gain ground in front of the elections and start to look out to the next year. And the third year in a presidential cycle, doesn't matter if they're Republican, doesn't matter if they're Democrat, is historically the best returns for the stock market. And we can talk politics if you want with regards to stocks all the times. The data says it does not matter. It's the Federal Reserve that matters. And I care about your money, and I care about the Federal Reserve.
So as we progress through the year, we're going to have more clarity with what the Federal Reserve will do with rate hikes. And I think it's also important to point out there's two components to the Federal Reserve's monetary policy over the past couple of years. It's been lowering interest rates to zero, but also printing trillions of dollars and increasing the balance sheet. They're only at this point talking about starting to gradually raise interest rates. They're not yet talking about contracting the balance sheet. So they've printed money, they've bought bonds, which is essentially driven rates down. Those bonds have literally been purchased. They're on the Fed's balance sheet. Many of you we've showed these charts to before. That part of the Federal Reserve's monetary policy is not at this time going to be withdrawn immediately. At some point they will start to bring it back, but right now all they're talking about doing is increasing probably 75 basis points, 100 basis points, which is 1%, the short-term interest rates, which does flow through to interest rates in the bond market, in the mortgage market, in auto loans and credit cards, et cetera. And that's ultimately why the economy starts to slow a little bit, or inflation for that matter, and things start to get a little bit more stable. But as we go through the year, we're going to have more clarity with what the Federal Reserve is doing. Right now, if the election was held today, it seems like Republicans would gain at least one, either the Senate or the House. The stock market historically likes gridlock. That means a lot of policy is not getting done, so like it or not. The stock market likes predictability. It likes things that it believes it can foresee into the future. And if we have divided Congress, that means for the next 2 years, probably not a lot is going to get done in Washington, which the stock market historically doesn't think that's a bad thing because it's predictable, it's comfortable, and it brings certainty to the overall future picture.
Troy had a great point, and I didn't talk about it. The Fed's balance sheet is a large issue. We've talked about it for 2 years. And it probably is not coincident that they are talking about the balance sheet starting to run off. Right now they're still buying mortgages, they're still buying treasuries, which is insane given how good the economy is. They're talking about stopping that come, I think, March, and then starting sometime June, July, letting the balance sheet start to run off. The data I've seen says if they don't sell bonds, over the next 2 years, $1 trillion of their balance sheet will just go back into the markets. And that's probably why part of the reason why you've seen such an increase in short-term rates too, because if all of a sudden, there's this big runoff of $1 trillion from the Fed over the next 2 years in very short-term bonds. The Fed doesn't own 30-year bonds. They own, I think the average maturity is between 6 and 8 years, something like that. They will, the money will be coming off the balance sheet. It'll be very short-term in nature. And, we've seen a rapid increase in short-term rates because the Fed's going to raise rates, but also they'll probably start loosening up that balance sheet, which is, I think, as much the market's concern as anything.
Okay, I want to thank everyone for coming out. I hope you guys enjoyed an early dinner there. And if you have any questions, you didn't want to talk on camera, feel free to come up to us, talk to us after this event here. But we're going to go ahead and wrap it up, guys, and just thank you very, very, very much for coming out. And we look forward to seeing you all very soon.
Thank you.
Thank you.